Welcome everyone to another webinar brought to you by OptionSlam.com. Please read and understand the CFTC rule before you risk your hard-earned money in the markets. Our disclaimer tells you that we are not licensed financial advisors. By attending these webinars, you agree to our disclaimer, and you'll have to read it on your own. And we do not make recommendations, etc., etc. All trades illustrated are for educational purposes only. I am Marco, and this is my email address, optionslam.com@gmail.com. Wow, that's the fastest I ever did that intro, right? Now, last week, I'm going to start over here. Last week, I illustrated a trade incorrectly. It's the ZIMS trade, spelled ZIMS or XIMS. Spell it however you wish. It's the 2 times the implied move long strangle. Since I illustrated it incorrectly last week, what I'd like to do right now is go to and recreate that, because if you did enter the trade and entered it correctly, that's what I'd like to illustrate. Where would we be right now? That strategy would still be on. We'd still be in it. It's showing some hope, although I believe it is underwater currently, just slightly. So, but let's go find out. And the way we're going to do that is we're going to go to Netflix by typing at optionslam.com by typing NFLX in this top right corner, clicking on that go button or hitting enter on your keyboard, and that's going to take you to the Netflix pages. All these are different pages that have to do specifically with the stock that you chose to analyze and investigate. We are going to go now to the Implied Move Weekly page. And the reason we're going to go there is to find out what strikes to use for the ZIMS trade, okay? The implied move was $50. Translated into percentage terms, 7.34% of the stock price pre-earnings close. The pre-earnings was October 17th. They're going to report after the close on October 17th. So the stock was closed that day at $687.50. Sometime late in that day, if you wanted to try the ZIMS trade, which, by the way, is a low probability trade. It is a low probability trade, but it has the opportunity for very high profits. Problem is, it loses more often than it wins. The good news is, it's pretty cheap to get into compared to any other strategy that we often talk about. But let me move on. $50 is the implied move at the end of the day on October 17th. So we're going to use that $50. And what we're going to do is we're going to go to the OptionSlam backtesting tool, which is, let me close that and go, and here it is under backtesting. We're going to go here. We're going to open that in a new tab. We're going to go to Netflix, NFLX, type that in that cell. And then the trade day would be 10/17/2024, and we're going to select that date. Then we're going to load strikes and expiration dates, and I oftentimes forget to click that button. Don't forget to click that button, because the tool won't work, or it certainly won't work properly if you don't click that button and load up all of the strikes available and expiration dates available. Next step is, this is fast and easy. Next step is select the strategy that you want to backtest. So we're going to go ahead and we're going to select a strangle, and then select whether you want to be a seller of that strangle or a buyer of that strangle. We're going to buy the ZIMS trade. That is a long strangle, buying the ZIMS trade. And what expiration are we going to use? Well, we use the front expiration. We use the implied move weekly, which looks at the front expiration. In this case, that would be the very next day. The options are expiring. The front week is the next day. This is Thursday the 17th, and then the front week is the Friday the 18th. But we don't use, that's what we use to gather the information of what is the implied move on that day, which we already determined is $50. But we don't use those options in this strategy. We use the next week out. So the Zims trade is going to choose not the 18th, but the 25th. Okay, I simply click on this area here, right here, in this field, and it gives me all the expiration cycles, and I select not the 18th, but the 25th, and that's it. Now we already determined that the implied move was $50. 2 times the implied move is, guess what? I can do that math even while I'm talking. That would be 50 times 2, $100. Stock is at 687, so I'm going to go to $100 away from 687 would be 587. So let's go to 587. Guess what? There is no 587 strike, so I can use the 585 or I can use the 590. I have to make a choice. I'm going to go ahead with the 590. 687 plus 100 to choose the call side. Right here tells you what fields to put, what strikes to put in which field, because this is the strikes area. So I'm going to choose the 797. So I'm going to go up to the 797. There is no 797. So let's see, 795 might be a good choice. So let's see, did I do that right? 690, let's go 690 down to 590 and 690 up to 790, okay? So I could have, in round numbers, that's what it would be. So let's run that trade, okay? Let's run that trade. And guess what? That would have cost $463. Now, the way I did it last week, I did it wrong. I forgot to double the implied move. So it was like $2,000 at the implied move to get into that trade. I forget the number. You can go into the Option Slam webinars and watch that webinar. It was a good webinar. It's just that I made a mistake. I caught myself while doing it, but I didn't fix it because we were running out of time, so we moved on. Now, right now, had you bet that $463, at the end of the day, Friday, you would have been down $205. Now, how is that trade doing today? So the trade was $463. Let's do this. Let's go look at Thinkorswim. 597.95 are the strikes. 597.95. Let's go into Analyze and let's get rid of this stuff. And let's add a simulated trade. We're going to go into the October 25th, and we're going to show all, and let's go look at that in profile, in P&L risk graph, and let's look at that trade and just translate that into, if we were in that trade, we would have been buying a strangle the 590 by 795, I think, is what we settled on. Pretty sure that's what we said. Well, here, we can easily just go look at that. 590 by 795, yes. And how much did that cost? $463.50. So let's put that value in here. We would have had to pay 4.64. Let's just round it to 464 to buy that strangle. And let's look at that in risk profile. Okay, well, in risk profile, right now, if you were in that trade, let's get rid of these extra price slices. Let's delete that slice and delete this slice just to remove any possible confusion. Let's look at this trade. Let's see this position here. And let's set this to let's set the shaded area to the the October 25th or 26th, because options actually expire on the 26th. So if you were in this position, currently you would be underwater by 250 bucks, okay? So what can happen? Price can either go down or price can possibly go up. So price needs to go up to about 800 bucks just to break even, and it doesn't have much time to do that. So this is the position you would be in. I could go into a lot of discussion about how would you manage this trade if you were in it. Well, it depends. There's a lot of things you could do. Okay, to adjust this trade, but we're going to just move on. I just wanted to illustrate that, and like I said, this trade, the ZIMS trade, is a low probability trade. We're going to lose on these more often than we win, but when we win, the potential for profit is unlimited. So if the stock really moves along here, there is no cap to how much money you can make, but there is a defined risk. The most you can lose is the $464. Okay, so there's all kinds of different adjustments you can make to this trade, depending on what your expectations are, or you could just close the trade, take the $257 loss, and move on. All right, so there you go. That was the ZIMS trade that I illustrated incorrectly last week. Now, I asked for, if anyone's here who has some trades that you would like to look at, we're just coming into the heat of earnings season now. We had much of the financials. Let's go over to optionslam.com and see what's coming up. So I'm going to close OSBTT here and go to the earnings tab, and I'm going to go to the stock screener. I'm going to quickly put in my generic screener. It's my saved set that I often use here in these webinars. And by running that, I came up with 42 companies that are reporting this week within the week. And here's the report coming out of the, these are all stocks that are going to be reporting this week, that have weekly options, that have EVRs over 1, stock over 20, and volume over 2 million. So just a quick scan. I could really narrow this list down, but let's see. Tesla is on this list, and Ciro emailed me and said, "Hey, I'm bullish Tesla. I think Tesla's going to move up big. So we're gonna see if we can design a strategy that meets Ciro's expectations." Tesla, he expects, is going to move up big, and you know what? I think Tesla is like, I have an opinion. And please don't trade based on Marco's opinion, because Marco is wrong about 50% of the time. Absolutely dead wrong. I picked the wrong direction about half the time. Okay? Maybe even 51% of the time. Marco is wrong. Okay? So don't follow my my opinion that I think Tesla's going to move up. I don't think it's going to move up big, but Ciro does, and that's the strategy we're going to try to accommodate Ciro in. And that's what you can do right now. If you have a stock from this list preferably, or you can narrow this list down by tightening up the criteria. But here's the top half of that list, okay? Tesla's included, coming up October 23rd. Well, that is Wednesday after the close, okay? And then here's the bottom half of that list, okay? And there's a bunch of interesting opportunities here, okay, for through the earnings types trades. So what we're going to do is we're going to go with Tesla, and I'm just going to, the way I like to use this tool in optionslam.com is I just put my mouse over Tesla, right click, and open that in a new tab so that we can go to the Tesla pages. Now the black bar turns into Tesla here, and we can go visit all these different pages to learn about Tesla and familiarize ourselves with the stock. So let's quickly do that. We're going to do this really quickly. Last quarter, last earnings event, July 23rd, the stock closed at 246 prior to the earnings, and then it opened up at 225, down 8.5%. And it ended up down 12.5% by the end of that day. Okay, pretty substantial move. The previous earnings, Tesla moved up 12% by the end of that day. It was up during that day by 16% at one point. Okay, but it ended up closing up at 12%, just about exactly where it had gapped up. Okay, et cetera, et cetera. So here's 12% moves in a row on Tesla. 12% moves in a row. Let's look at some of the other prior moves. I'm going to look at the closing move only right now, rather than the max. About 10, about 10, about 11, about 7, and about 10. This earns Tesla an EVR of 4.0, which is I consider 4.0 to be a relatively high EVR. Earnings volatility rating. Learn about the earnings volatility rating right here at Help EVR. Earnings volatility ratings range from 0 to 10, 10 being the highest. 4 is a high EVR. In my opinion, 4 is a high EVR. It says, caution, be careful, this stock can really move. The only problem is that we can't predict the future. We don't know which way. Okay, so Ciro says, I think it's moving up, and I think it's moving big. So big, well, is big 12%, or is it more than 12%? Well, let's go learn a little bit more about Tesla. Let's go to the implied move weekly page. We can hit the trend analysis page just to get a quick look at the Ichimoku, and the Ichimoku is fairly bullish because price is above the cloud. Okay, however, there has been a cross down recently, which suggests there is a potential threatening of trading through and possibly into and under the cloud. Okay, so you got to be careful when you see the cross. That's a little bit of a warning sign. There are webinars a year or two ago where we delved into, with the help of Leonard, one of our Option Slam traders. Let's see, under Option Slam webinars, you can just search the webinars for Ichimoku to see one of our Option Slam webinars about the Ichimoku. But let's move on. Let's go to the Implied Move Weekly. And Implied Move Weekly, okay, this looks like a split. Yeah, this must be a split. Let's see, I don't remember. 2022. Yeah, that sounds right. So this chart is a little bit hard to read because of that split. It doesn't adjust for that. I need to talk to IT and see if they can do something about that to get these charts to adjust for splits. But anyway, let's see. The implied move from is currently at 7.39. Now, I only want to do one thing. I want to test. I want to just look at 7.39. I want to see what are some previous implied moves. Is this a high implied move or a low implied move? If it's a high implied move, it suggests that options are being priced high. In other words, there's a lot of premium built in. There's implied volatility, which is a big factor that determines option premiums, especially at earnings events, because implied volatility is at its highest right before the earnings event. So let's just comparison. Let's just do a visual comparison here. 7, 9, 9, 7, 6.5, 7, 7, 8.5, 9, 6. So I'm going to say that implied volatility based on the implied move analysis here over the last 10 or 12 events is about in the middle. It's not really high. It's not 9, it's not 10, and it's not 6. It's in the middle, and it's pretty average. So I don't really have a problem buying options. So we can do an option strategy, but what we want to do is we want to accommodate Ciro's expectation that the stock is going up. So I think one strategy that we should consider here, Ciro, is let's go to Tesla and let's go to the ad simulated page. Okay, now the other strategy that we've talked about quite a bit lately, for if you're expecting a big move on a stock, is just buy the stock, right? You can just buy the stock, okay, but that costs a lot of money. So the other strategy that we talked about is a stock replacement strategy that we call the Zebra. Now, there was a webinar about zebras just a few weeks ago that we had here at optionslam.com. Also in the webinar archives is the Zebra, where we really dug in deep and we explained how to trade the Zebra. So let's try a Zebra strategy. Zebra is the zero extrinsic back ratio. That was Zebra stands for, ZEBRA, zero extrinsic back ratio strategy. So let's do a Zebra. Now, I like to do my Zebras out about a month. So here's the monthly. I gravitate to the monthly because it's not quite a month. I could go to the November 22nd, but if I use the actual regular monthly options, which are highlighted by being white here rather than this yellow color in this particular trading platform, if I use the monthlies, I gravitate to the monthlies. Why? Because they are the most liquid. Usually they're going to be more liquid. What do I mean by that? In other words, there is, okay, I got the wrong, let me go to, let's see, volume, open interest, Delta Gamma Vega. Okay, oh, I see. I'm in my simulated trading thing here, so I don't have all of my different. Let's see, out of the money, implied volume. I'm going to have to customize this. Volume, open interest. Okay. All right, so that's enough just to illustrate the point I'm going after here. So if we go to the November 15s, the volume on those at the money contracts is 12,711 contracts today. That's today's volume, okay? That's 12,000 contracts at the 220 strike traded today on the call side, and 16,000 volume on the put side. You might say, oh, Marco, there's a lot more volume on the put side, so that the traders must be bearish. No, that doesn't mean anything. Because we don't know without doing further digging whether those are 16,000 buys or 16,000 sells. Did they sell the put? That would be bullish if they sold 16,000. Well, we also know that it's not going to be 16,000 on just one side or the other. It's going to be a mix of buys and sells. So you would have to do some digging, and most this particular. I'm not going to get into that today. We probably should someday. We should probably get into option statistics and options time and sales and product depth, get into these three opportunities to dig deeper. But here, let me get back to my point. The point is I'm not going quite a full month out. I'm going just out 25 days because I prefer to use the monthlies rather than these. Let's go look at the options here to illustrate my point. Let's go to that same strike, the 220. In the 220, there's 730 on the call side today volume. And on the put side, there's 498. It's a far cry from 11,000 and 14,000, isn't it? Volume. So that's why I like now. The liquidity is still pretty good here, and I can tell because the normalized bid-ask spread is tight. There's not a huge difference, and I can still trade these options and get a fair price if I was doing the at the money. But with the zebra, we're not doing the at the money. We're going to do the we are going to do one contract at the money. So let me get back to the zebra and let me go. I sidetracked. I'm sorry about that, but that's a bad habit I have. I go off on tangents. So the zebra, zero extrinsic back ratio. Here's how you do the zebra. You go find. We'll have to add delta in here because we need the delta to know which option. That's how we're going to choose. There we go. We added delta. All right, so now we have a delta count. So we are going to look for the options that have a 70 delta or as close to 70 as we can get. Right now, it just so happens that in the options that are out to November 15th, the 205s have a 70 delta. So the zebra buys to now. If you were to buy the stock, you would be buying, let's say, to control 100 shares, you would have to buy 100 shares of Tesla. It would cost $218 per share, right? Times 218 times 100 shares is going to be $21,800, right? $21,800 to buy 100 shares. So I'm not sure that you or I or anyone here today wants to spend $21,800 on Tesla on a gamble that the stock is going to go up overnight. But this is a stock replacement strategy using only options that's going to simulate a risk graph that looks like you bought 100 shares of stock. And that's what buying 100 shares of stock looks like. So we want to simulate that by using the zebra strategy and risking a lot less money or putting up a lot less money. Let me put it that way, putting up a lot less money because the risk is virtually the same. But let's go back to, so where were we here? Okay, there's the 70. Okay, so here we go with the zebra. We're going to buy, when I left click that, it puts one of the November 15, 205 calls. I'm going to hold my control key down and buy that again. Okay, now I'm buying two. It just changed the amount. And I'm going to sell the 50 delta. So I'm going up and looking for the strike that is closest to the 50 delta, and there is the 49 right there. I can sell the 468, or I could choose the I'm sorry, what did I say? Not the 468. The 222 strike or the 220 strike, because strike right now it's at 218. I don't like to go that far out of the money to go to the 222. The 220 is already out of the money, and it already it's slightly over the 52 delta. So I'm going to choose that, and I'm going to control key sell the 220. Okay, so let's look at my strategy. This is the zebra, and that's all there is to putting on a zebra. It is a stock replacement strategy. I'm going to buy two of the 70 delta 205s and sell one of the 50 delta 220. And let's take a look at the zebra trade. Now, notice the zebra, the red line, the today line, is almost exact replica of buying 100 shares of stock. To the upside, it is a perfect replica of buying the stock. To the downside, it still replicates buying stock. That means it still has the same risk of buying stock, except if you're wrong and you hold this too long, the zebra can lose money at a steeper rate than buying stock if you hold it too long. So it's important, if you do the zebra strategy, and if you're wrong about direction, that you manage the trade immediately. Don't hold on to it very long, because every day you hold on to it, the losses get worse exponentially, and the purple line eventually becomes the blue line as you move forward in time, which I'll just simulate here quickly, until finally on expiration day, the purple line becomes the blue line. But the only caveat is that the option strategy limits your losses to a maximum loss of the debit paid, which was $29, which is 2,000 times 100, because it's a option strategy. So the most you can lose is $29 times 100 would be $2,900, where stock continues to lose. There is no downside loss. But anyway, in any case, there is one strategy you can use. Now, another strategy, bullish, and this one is a little bit more my style, because like I already said, my opinion is that Tesla isn't going to the moon, but I am somewhat bullish on Tesla's earnings. Again, I could be dead wrong. I'm wrong at least 51% of the time. So let's take these strategies out of the picture. Any questions about that? Any questions about that? I'm confused. Why would you buy the put and call so far out of the money? Wouldn't that make sense if you were shorting each side? Yeah, but it's a completely different trade. So Andrew's asking about the ZIMS trade. Why would you buy those out of the money options? Wouldn't you be better off shorting them? Well, yeah, in this example, let me show you. Let's go back to that. I'm sorry I didn't see your question timely, but I'm going to get to it right now. NFLX. And Andrew brings up a very good point. He says, why wouldn't you just sell that? Let's see, what do I have modeled up here? Let's see, that strangle, buy that strangle. Oh, I need to reset parameters and date. Let me reset parameters and date. There we go. So, well, if I would have sold that strangle, the 2 times the implied move, here's the opposite trade. Let's sell that strangle. Well, if I would have sold that strangle, I'd be profitable $225 right now. Brilliant. Problem with this trade is that it has unlimited potential for losses. And it takes a whole lot of margin to put on this trade. And it has a much higher probability of profit. It's the opposite trade. Why would you buy the strangle is the question, as opposed to selling the strangle? Because this trader thought that Netflix was going to go real big. It was going to move a huge amount. This trader thought that Netflix was going to stay inside 2 times the implied move. And it's just a difference of opinions. 2 different traders, 2 different opinions. It takes 2 to tango, and it takes 2 sides to enter into and have positions in the market. There's buyers and there's sellers. Okay, so it's just as simple as that. I hope that makes sense. And why would you do this? Why would you do this long Again, to expand on that just a little bit more, well, there's a lot of recent examples, but the one that comes to mind, I don't have it modeled in here right now. The one that comes to mind is Dollar General on this earnings event. Had you bought the 2 times the implied move ZIMS trade, you would have made, I forget how many 1,000% profit on a very cheap trade. 2 times the implied move. I don't remember the numbers. We could go in and go back into Option Slam backtesting tool and put that trade on right now. Easily done, just like we did with the Netflix trade. And we could determine exactly what the profit would have been on the ZIMS trade. But it was phenomenal. And guess what? It was huge. And when you have one big winner like the Dollar General ZIMS trade was, it pays for many, many, many losing ZIMS trades and still have money left over. Okay? The thing is, people don't like to put on the ZIMS trade because people don't like losing most of the time, and that's what the ZIMS trade does. It loses most of the time. All right, so hopefully that helps. And George says, for the zebra, do you ever use a leap instead of stop? Well, you can use any option you want. I recommend the reason, let's go back to Tesla on the Tesla was our, what happened to our trade? Add simulated trades, risk profile. Did I delete all of our trades? Did I? Yeah, I did, because I was going to illustrate another. Okay, so I'm just going to answer the question. Thanks, George, for the question. George wants to know, can you use leaps instead of? Well, yes, okay. Typically, all right. I'm going to go off on a little bit of a tangent here to answer that question. Let's put the trade back in. I illustrated it with the 25 days to expiration. The options were the 205, which is the 70 delta. I'm going to buy 2 of those, and I'm going to sell the at the money 220, which is actually a little bit out of the money. And we're gonna. So there's that zebra, $29. Let's look at it in risk profile. Now, what if instead of going out only 25 days, what if George asked the question, why not do the leaps? Well, leaps are typically a year out. Okay, so let's look at the January January 26. We could do the December 26th. That would be closer to exactly 1 year out. Here's the January, June. We'll just choose. We'll choose the December. Okay. If we choose the leaps, now our investment goes from $2,900 to $2,900 to 144. That's what times 100, right? So 144 times 100. $14,400, right? 14,000, yeah, $14,400. So we go for, so there's much more money at risk. Now, what's nice about the leaps in this particular instance is that the theta, let's look at that theta. It's the middle Greek here, 17.7. And if we change, oh, wait a minute, I got to change all of these to December 26th. Okay, December 26th. I didn't quite do that. Why didn't it change? Oh, because it's a custom. Okay, so I got to remember, I got to do the December 25. Jan 26, December, where did my December 26 go? Here they are. December 26. There we go. December 26. Okay. Okay. So the today line replicates stock. However, all right, now we're at 83, so $8,300 as opposed to $2,900. Okay. But the theta is at a negative 4.48 per day starting out. That changes. It's dynamic. It changes, but it's losing only $4 per day. But as time goes on, you can see that this leap option ultimately loses value. Honestly, I've never modeled this up with leaps, so I'm trying to wrap my head around this. It's saying that if stock goes up tremendously, you make a lot of money today, but if you hold it too long and you hold it all the way to December of 26, even though the stock goes up to, let's say, $240, you end up losing money. You end up losing about $3,300, it says here, if you look at the bottom left-hand corner. So I have to wrap my head around that, exactly why that is. But, for a very short-term play, the pro to using leaps is that the immediate theta decay is very low. The short-term theta decay is very low. It perfectly replicates stock, both downside and upside. But don't hold it too long, even if it's a winner. You need to manage it either way, which is true of the other side too. You need to manage the zebra if you're going to use the, I think I did this with the November 15, even with this trade, the upside is just, beautiful. This meets Ciro's bullish and moving big expectation. If you want to evaluate your stock, please send me an email for next week's webinar to evaluate your stock, okay? All right, so there's, I hope that answers that question, George. There's pros and cons to everything in designing option strategy. There's advantages and disadvantages. So, all right, so let's move on to, let's move on now to, and all other options are short-term. Only the stock is replaced with the leap. Only the stock. Okay, what I meant is that all other options are short-term. Only the stock is replaced with leap. Okay, I guess I don't understand that. But what we were analyzing, I don't understand that last comment, so I'm not clear on that. But yeah, you can use leaps. There's advantages and disadvantages. I tend to just use, when I'm doing a stock replacement strategy, such as the zebra, I tend to go about 1 month out. Now, the other thing that I could add to that conversation is that you could go 3 months out and take into the consideration the next earnings. So there's an in between too. There's the 1 month out. Why wouldn't I use the front weeklies? Okay, so there's another question. Why wouldn't you just use the front weeklies? That'd be cheaper yet. Okay, well, let's look at that, and I'll show you why we wouldn't do that if you don't already understand. If we just chose to use the October 25s, and let me change this one to October 25s. Okay, October 25, 2024 doesn't save much money. All right, it's $2,400 instead of $2,900. Doesn't save you much money up front, and the risk graph quickly, very quickly, if you're wrong about direction. And even if you're right about direction, you don't make as much money. It's not replicating stock perfectly. You see how the purple line isn't totally in alignment with the expiration day line, so it's not making profit as fast as the 1 month out. And if you're wrong about direction, it quickly loses money, as we can see if we just fast forward this just a few days and go into the final days of this week. If price goes the wrong direction, this is losing money faster than if you would have bought the stock. So that's why we don't want to go too short in time. It doesn't really save you much money up front. I find that 1 month out is the sweet spot. It's the nice balance of how much money you got to put up to replicate stock, 2,900, to buy 100 shares or replicate owning 100 shares of Tesla. It's the sweet spot, in my opinion. All right, let's get rid of that. Let's reset parameters and date, and then I will show you one more. This is a real simple strategy, and it makes a lot of sense. And okay, somebody says, well, why not just buy the option? Well, go to Option Slam webinars and go view the webinar in the webinar archives. All of you guys who buy options right before earnings, go to, let's see, resources, Option Slam webinars, and search for, the way to search that is simply to use the find function in your browser. Find function, okay? Use the find function and search for stop buying. Just type in those 2 words, stop buying, and you will find a webinar called Stop Buying Calls and Puts at Earnings Events. Stop it. Stop buying calls and puts at earnings events. Why? Because implied volatility crush. We've talked about it 101 times in these webinars. But if you buy a call, even if you're right about direction, you can still lose money. In fact, you often will lose money because the implied volatility crush will suck the premium out of your option contract. You buy a call and you're right, stock goes up, and then you look to see how much money you made and you discover that you are underwater. You paid more for that call yesterday than it's worth today, even though you were right about direction. So stop buying calls and puts. Instead, engage in option spread strategies where you are hedging. An option spread strategy is a hedge. It is building in a hedge against, in this case, as we're talking about option strategies at earnings events, and we're buying options. What we're going to also do is sell options. So let me illustrate a perfect illustration that answers that question. All right. Let's say that Ciro is bullish on Tesla, and he goes into the market and he says, I think Tesla's going up, and I think it's going up big. All right, so he might go and say, you know what, I'm going to buy a call. I'm going to buy this call. Now, you can buy any call you want. I'm just going to illustrate this with buying the at-the-money call, okay? In this case, it's slightly out of the money, the 220. I'm going to illustrate. Now, I could illustrate this with an in-the-money call, an out-of-the-money call, and the results are all going to be similar, not the same. But to illustrate my point and to illustrate an option strategy that I might consider for this particular earnings event, would be to not just buy the call, because what's that look like in risk profile? If I just buy the call and hold it to, let me take this back to the front week weeklies. Let's keep it on the down low. All right. That's going to cost $680. What's that mean? That means the stock needs to go up $6.80. If I'm going to hold it till the end of the week, the stock needs to go up $6.80 just for me to get to this little red hash mark, the break-even point. Now, if stock goes up faster than that, great. But here's the problem. Implied volatility crush. If I just buy the stock, buy the option, and implied volatility crushes too. Let me just find out what do I think IV is going to crush to. I think IV is going to crush by the end of this week down into the actually it's going to crush all the way to 0 by the end of this week. But let's just look at the short-term IV crush. It's going to crush down to, let's call it 55 from 80. So 80 less 55 is 25, right? 25, yes. So let's go back to analyze, and let's use the analyze software, and let's look at an IV crush of a negative 25 points. Okay, if IV crushes 25 points, this trade looks like this tomorrow. Now I need the stock to move at least up to 222 just to break even by tomorrow. Okay, because IV crush sucks the value out of option premium, and that's what happens at earnings. So instead of just buying, let me reset parameters and date. Instead of just buying, and let's go over to optionslam.com a minute. And are we on the Tesla page still? Yes, we are. So let's see. 7% is the implied move. The current implied move is about 7%. So 7% of a $218 stock, $218 times 7% is $15. All right, $15. So the market is suggesting a move. The options market is implying a move of about $15 on these options, okay, on the stock. The market is suggesting that the move is going to be up or down about $15. So I have learned from my many years of trading that the option market is very good at pricing in implied moves. It is more often right about implied moves than it is wrong about implied moves. Another thing I've learned about the market pricing in implied moves is that the market is usually, the market moves usually inside the implied move, less than the implied move, not more than the implied move. More often than not, the market move is under the implied move, not over the implied move. So therefore, the implied move is $15. I'm going to use that knowledge and my experience, knowing what the market usually does, to, instead of just buying this 220 near at the money call, I'm going to go and I'm going to reduce my amount of money at risk. Now, I'm going to give something up for doing this, because right now this trade has unlimited potential for gains. And if Cyril's right that the stock is going to go up and up big, he thinks it's going to go up more than the $15 implied move. And he could, even with buying this long call, a move up over $15, let's see what that would be. Stock is at 218. 218 plus $15 is 233. That would be all the way up. Let's put this price slice right here. That would be all the way up to there. Now that's holding until this Friday, because this is the front week weeklies. Holding till this Friday, even suffering the IV crush, this bet of $670 to buy this call ends up making a profit of about $900, more than doubling your money. But me personally, I don't want to risk the $670 because I know that stocks don't usually move beyond the implied move. Now, Tesla is one of the exceptions. It does have, let's remind ourselves that Cyril could be right. I don't want to talk him out of anything because Tesla is a 4.0 EVR. It often moves what? We already learned earlier. Let's go back to the earnings history page. We already looked at this. It often moves 12%, 12%, 12%, 3 earnings events in a row. Well, 12% on a $218 stock times 12% is a $26 move. A $26 move, much more than the current implied move of $15, okay? But again, I'm covering a lot of ground here and I'm jumping around just a little bit, but if you're listening and following along, this should all come together and make sense. My personal way of trading is to be a little bit more conservative and not shoot for the moon, because shooting for the moon in this example requires exposing myself to not only being wrong about price, but also suffering the implied volatility crush. Okay? So what I would do personally, what I would consider doing, or ask you to at least consider doing instead, if you're bullish, you can do this. If you're bearish, you just do the opposite, right? Do the opposite and use puts, but I would look to go out $15 to the, let's see, 220 plus 15 is going to be the 235, okay? Or the 230, 250 might be even better, right? Because that's closer to, from 218 plus 15 is going to be, the closer strike is going to be the 230. And I'm going to turn this into a bull debit spread by control key, selling the 230, 250. Now, instead of risking the $680, I'm only risking $437. And if price goes to 233, where we put this price slice, I'm capped. My max profit is capped at $800. But you know what? What's wrong with an $800 profit as opposed to if I didn't cap it, the profit would have been only $900, $935, I think it was, at that strike. Okay? All right, let's look at those individually. Let's just buy the 220, all right, or buy the vertical. All right, so here, and this is what that options webinar called Stop Buying Calls and Puts is coming down to. And I don't remember the webinar. I think it was a year or two ago. Maybe it was further back than that. You'll have to look for it. I'm sure I illustrated this exact concept, and that is just simply turn your long call or your long put into a debit spread. That neutralizes the Greeks. It reduces your exposure to IV crush, because now not only are you suffering the IV crush of the long option, but you're benefiting from the IV crush on your short option. So neutral. So let's look at those Greeks. Let me show you that quickly. So here's just the long call. What is the vega exposure? That is the Greek that responds to implied volatility crush. Well, I'm long 9 vega in this trade. That means if the stock gets IV build, if the IV increases, I'm going to make $9 for every point of IV increase. The problem is we know that IV is not going to build. It's going to crush. It's going to go down. So that means now I'm going to lose $9 of implied of option premium for every 1 point of IV crush. And what did we say? The IV was going to crush like 25 points. So that's 25 times 9 by the end of the week. Or maybe, certainly by the end of the week. Now, what happens if I turn that into a vertical spread? Now, instead of being long 9 points of IV, now my IV crush factor is only 2 points. That is a lot more easier for me to take on that risk of IV crush when it's only 2 points as opposed to 9 points. It's almost 5 times. It's like half as. It's almost a quarter. It's a quarter as much, right? So the IV crush, and plus, instead of risking $685, now I'm only risking $440. And what am I giving up on the long side? Not that much. Not that much, unless stock does what Cyril thinks it's going to do and move very large, and then my profit could be, again, at 233, it's only $900. I'm not giving up much at all by going to the vertical at 233. I'm only giving up $100 of profit at that 233 strike, at that 233 location. All right, so let's see. What if you hedge the call with a bear call spread? A bear call. Oh, well, that would be another great hedge, and that's what that's another good hedge. Okay, let's see. What if you hedge the call with a bear call spread? Okay, good. All right, let's look at it. Let's look at it. Instead of turning it into a vertical, okay. If you do a bear call spread, it is, so that's not, okay, so it would have to be an out of the money bear call spread. Let's look at it. It's gonna add a lot of risk. All right, let's stick with the options that we're in, the option cycle that we're in. If I was to do that, I might want to look a little bit further out in time. But you're going to bring in some. So let's go to that zone, that implied move zone, which is about $15 away, right? Which is the 232. A bear call spread would be to sell the 232, where the options market is pricing in the implied move of $15. So what we're going to bet on is let's bet with the implied move and say, I don't think stock can go beyond that 230, 250 in this earnings event within the next week. And then then we don't want to just short that, because what does that look like? Okay. There's buy a call and sell a call. That is actually the same thing as I'm doing right there. Buy the call, sell the call. But instead of just selling the call, invest in is suggesting sell the call spread. So sell the 232 and buy for protection the, I don't know, let's bring in at least half. So let's go up to, let's just go up to the 237. That's going to bring in a little more than half of the cost of this. But you can play with this however you want. But I'm just, for illustration purposes, I'm going to, I did that wrong. I want to sell the 232 and buy. There we go. So there is the bear call spread. it brings in a credit, but only 97 cents using the strikes that I chose. Now you can manipulate that and work however you want. I also use the implied move. It's just, and then let's combine that with the long call, okay? And I don't see a great advantage to it. Now there is another trade that this reminds me of, which is an excellent trade. It is the single-winged iron condor, all right? The single-winged iron condor is another strategy that I spoke about extensively, and there's many of you who are still trading the single-winged iron condor. The problem with the single-winged iron condor is that it exposes you to unlimited losses. There is a naked short option involved, but thanks for bringing this up, Invest, because it reminds me of the single-winged iron condor. I'm going to illustrate the single-winged iron condor here with Tesla right now, and because this kind of makes sense. Some of you may not be bullish on this earnings event, or you may not be bullish on Tesla, but you know what? A lot of people are bullish on Tesla, at least long term. So this might make sense to some of you. So let's get rid of all this stuff. Clear the slate the clear, and let's look at the single-winged iron condor. So here's how single-winged iron, again, extensive, lots of webinars about the SWIC, what I call the SWIC, SWIC, single-winged iron condor. I call it the SWIC trade. All right, the single-winged iron condor. We're going to use, again, we're going to use the implied move. I always respect the implied move, but I also respect the EVR. I know that this stock can move what? Outside the implied move, outside. It can move outside the implied move. Look at all these instances on the implied move weekly page. Let's go to the implied move monthly page. Let's respect the fact that this stock can move. Now, on the monthly, the longer term trades, there's a lot less outside the implied move. So this tells you at a quick glance that the immediate reaction to Tesla earnings event can be extreme, but over a little more, apply a little more time, and things moderate, things settle down a bit. Okay, but let's go back. You guys are sharp out there. You guys are bringing up a lot of great points. All right, so let's look at the single-winged iron condor, because I think that I could be wrong. Maybe some of you are Tesla bears and you think Tesla's going to zero and robo-taxi will never happen, or whatever your thoughts are. The EV market is, whatever your thoughts are. Personally, I'm long-term bullish Tesla. I actually own stock in Tesla. And so I am long-term bullish in Tesla. And I am also currently short-term, just modestly bullish in this earnings event. But that's, like I say, I'm wrong 51% of the time. Let's look at the single-winged iron condor. So for the single-winged iron condor, I'm going to go out to the monthlies. I like to buy a little time. And this helps me in case the stock moves in the wrong direction. It gives me, so I'm going to go to the 218s, and I'm going to go to the implied move below, and which would be, let's see, 218s less 15. Okay, where are we at? 218s. Here we are. Less 15, about the 202. I'm just going to take the round number and go just a little bit further. I'm going to go out to the 200. I'm going to sell that option. Okay? Now, in an iron condor, what would you do? You would sell the vertical. You would sell that 200 and you'd buy the 195. Okay, you'd sell the vertical bullish put spread. Okay, that's what you would do with a regular iron condor. In this single winged iron condor, I'm not going to buy the wing. I'm just going to sell the short. And I'm going to go out to the other side, the 222, and I'm going to I want a little bit further on the put side, so what if I want a little bit further on the call side too? Let's go an extra 250 on the call side too. On the call side, I'm going to actually sell the vertical. So I'm doing this in 2 steps. I would not recommend that you do trades in 2 steps. You can put this all together as one order. I really like doing trades as one order. And the 200 is 515, so 5 by 525. So you're actually probably going to be able to get filled at about 520 on that and 97 on that. So here's what the single winged iron condor looks like in risk profile. All right, here's what the single winged iron condor looks like in risk profile. It has unlimited risk to the downside. You're exposed to, if the stock moves below, it brings in a credit of 520 plus 95, so about 615, a total credit of about 615, okay? And even if stock overshoots on the call side, where is price now? It's right. Let's get rid of these slices. Delete that slice. Delete this slice. So here's what the worst thing that could happen. Stock goes down and it falls below your break-even point, and it stays there all the way until November 15th. You will, if you're still holding the position, now, of course, there's many adjustments you can do in the meantime to reduce the loss, bring in more credits, et cetera, et cetera. But if you do nothing, which I never recommend doing nothing, well, I shouldn't say that. I often recommend doing nothing, but in this particular type of a strategy, if it goes against you, I wouldn't recommend doing nothing. I would do something. But anyway, the point is that if you are long-term bullish, well, then you wouldn't mind buying the stock for $520 since, for $200 when today it's trading at $218. So you're getting an $18 discount on the stock. So this is exposing yourself to that risk. But if you're long-term bullish on the stock, why not go ahead and let them put the stock to you at $200. If you want to turn it into a wheel strategy, okay, the wheel strategy is simply just sell the put, okay, and then let them put the stock to you at 200 and turn it into the wheel strategy, right? Everyone knows what that is. Turn it into covered calls. You sell the naked put. If the stock gets put to you, then you start selling calls against it. The theory being that eventually the stock comes back, and in the meantime, you've collected all those premiums that you sold of covered calls, and eventually the stock comes back, and it's a very popular strategy, probably one of the most popular, not the most, but probably one of the most popular option strategies out there is what they call the wheel strategy. But anyway, the single winged iron condor looks like that. All right. You can adjust the strikes to your liking, shift and move risk around. Another bullish strategy to consider. So thanks to Invest In for making me think of that option strategy. All right, so we got a late start and we are over time now, and so we'll have to call this meeting to a close. Thanks everybody for your participation. I look forward to hearing from you in the email optionslam.com@gmail.com. please shoot me an email, and we will see you again here next week, same time, same place. In the meantime, thanks for being here and wishing you all good trading.